Good afternoon, and welcome to a new episode of Nature's Returns, Investing in Ecosystem Services, a webinar series hosted by the Yale Center for Business and the Environment. My name is Olivia Sanchez, and I will be your host for today's presentation. The Nature's Returns webinar series addresses the growing importance of ecosystem service valuation and investment. Today, we're closing our season and, in fact, wrapping up the series related to ecosystem services and human health that we have been covering this spring 2017, which included presentations with EcoHealth Alliance, Kaiser Permanente, and Restore the Earth Foundation. Today, some of the topics our speaker will cover, in fact, have to do with an interesting public health initiative that he will talk more about. So joining us today, we have Brian Kittler, the director of the Pinchot Institute's Western Regional Office. Brian leads programs focusing on improving public engagement and leadership in federal lands policy, developing new markets to advance forest restoration and climate adaptation, creating incentives for private lands conservation, and improving policies to support forest carbon sequestration and storage. Previously, Brian managed a grant-making portfolio for the National Fish and Wildlife Foundation, providing financial and technical assistance to local governments, land trusts, and watershed organizations restoring the Chesapeake Bay watershed. Brian has a BA from Colby College in Environmental Policy and an MS in Environmental Management from the Johns Hopkins University. So Brian will review lessons and insights from a recent project in the Pacific Northwest, attempting to overcome transaction costs and change the market structure to scale the carbon market for family forest owners, as these pose a promising mechanism to help finance sustainable forest management practices and conservation projects. Today's presentation will be recorded and available on the CBay YouTube channel and on the Nature's Returns iTunes channel, so you can check back to re-listen to all past webinars and the one from today. Last but not least, before we start, I'd like to remind our listeners that we will have about 15 minutes for Q&A at the end of the session. So we encourage you to type your questions in the Q&A section at the bottom of your screen throughout the presentation, and we will be directing them to Brian at the end of the program. So Brian, thank you for joining us and welcome.
Thanks, Olivia, and thank you for everybody for joining us today. I really appreciate your time, and hopefully we'll have a good conversation here. And also, Olivia, thank you for referencing the connection back to public health and health outcomes and environmental conservation. This work that I'm going to talk about really kind of began actually looking at that connection, and we were investigating sort of some of the drivers of forest loss and unsustainable forest management with family forest owners in the U.S. And given sort of the age demographics, the pressures on the land base, and the issues that these families deal with, healthcare and medical expenses were actually a very important financial constraint that dictates a lot of their decision making. So we were looking for options for connecting landowners with new income streams to help offset not only the healthcare expenses, but all the management expenses and challenges, financial challenges that they face. So without further ado, if I can figure out how to advance the slides here, there we go. So what I'll hopefully cover in about a half hour and leave enough time for some Q&A are, at the very large level, threats to forest carbon conservation in the United States, opportunities for forest conservation through carbon markets, and with a particular focus on family forests, and a pilot project that we did and some of the lessons learned coming out of that. And I'll talk a little bit about, where I see opportunities moving forward. Okay, so our first section here, in terms of the threats to forest carbon in the U.S. Stepping back, looking at the entire country, this image here from the National Climate Assessment shows tons of carbon stored in forests per hectare per year. And the darker color, the cooler colors, the purples and the blues, typically are more carbon dense forests along the coasts. And in particular, the Pacific Northwest, where our work has been focused, is an incredibly carbon dense region. And across the country, forests are annually sequestering about 11% equivalent of the U.S. entire portfolio of greenhouse gas emissions. So it plays a pretty significant role. An additional 4% is stored in wood products annually. However, with this, we've only just regained about a third of the carbon that has been lost since the deforestation of primary forests in the eastern U.S. So we have a lot of opportunity for improvement going forward. And when you consider the future trajectory of forests in the U.S., there is cause for concern. The most recent Resource Planning Act assessment of the Forest Service and other assessments from other government agencies, such as USGS, show that due to deforestation and degradation, within the next 2 to 2.5 decades, we could actually see a flip from our forest being a net sink to a net source of carbon emissions to the atmosphere, which is certainly not the direction we need to be going at this point, given climate change issues. So big drivers of this, again, deforestation. A lot of the Atlantic coastal plain has started to look like this, particularly in the southeast, with migration patterns and demographic changes and shifts, populations moving south from the northeast, population centers in particular. And typically this has been having a loss of forest and open space at a rate about 4 acres a minute, which could result in a total loss of 34 million acres by 2060. So that's a lot of standing carbon volume that could be transitioned to a less carbon dense landscape, whether that's agriculture or housing and other suburban and urban developments. And the real driver is population growth. We could see significant growth again in the southeast and in the Pacific Northwest, both, if you recall from my first slide, tremendously carbon dense regions. So the second real driver of potential carbon loss is forest degradation. And this image here is actually just a Google Earth image of the Coast Range in Oregon. It's a landscape in which we're trying to advance some carbon market opportunities. So on private lands, if you think about the private lands in the country, really being split up between the industrial lands and the non-industrial forest land, institutional investment expectations related to timber investment management organizations, real estate investment trusts, they're typically operating on a 10-year investment time horizon. So they expect returns, and that has some limitations on potential total carbon storage on industrial timberland. And on the close to half of the U.S. forests, which are family owned, so this is the non-industrial forests, there is significant potential to increase carbon stores, we believe. However, since many of these lands are predominantly owned by people who are land rich and cash poor, liquidation harvests, unplanned timber harvesting is fairly common. Healthcare is a driver of some of that activities. Tax issues are another. So finding new mechanisms, new income streams could be incredibly important for conserving those carbon stocks and expanding them into the future. And making all this even more challenging, we have a large-scale ownership transfer currently underway, with the majority of the family forest land owned by people over the age of 65, many of them over the age of 75. So the motivations and the willingness and sort of conservation appetite of that next generation is really important from a carbon storage and carbon management perspective. Okay, so in terms of looking at the carbon market, as an opportunity for forest carbon conservation, it's important to think about the fact that there's really 3 different project types. You have improved forest management, you have reforestation or afforestation, essentially replanting following an unintentional disturbance, and you also have avoided deforestation. Most of what I'll be talking about today is improved forest management. And the most important concept to understand when you think about improved forest management, what exactly does that term mean? It's basically a comparison between a business as usual scenario and a project scenario. So if you were to think about, okay, the average forest rotation and carbon stocking in the Northwest is about a 40-year even-aged uh, type silviculture situation, as depicted in the top graph here, starting at about 60,000 metric tons standing carbon, and then operating on a 40-year rotation of even-aged management. If you were to think of that average carbon stocking of repeated rotations, that average stocking baseline would be about 20,000 metric tons sequestered across this property. And that baseline scenario, and again, that's for a profit maximizing landowner in a financial market sense, that gets compared to a project scenario. And that project scenario would basically be any type of forest management that would basically expand the carbon stocks above that baseline scenario. And that is potentially creditable carbon. So looking down at that second graph, you see instead of harvesting intensively in the first couple of years of the project, they elect to extend the rotation another 20 years. And it is some type of variable retention after that. So you're maintaining carbon on that property. So that's essentially the concept of carbon additionality. You're storing additional carbon than you would have in the baseline scenario. And the way that we get additionality in carbon projects is through extending rotations. In some instances, forest ecosystems could actually be extending past the financial rotation to doubling that and actually producing significantly more wood volume. And another concept is leaving more standing volume when harvests do occur. So that can occur in larger reserve areas or retention systems. And a third way is through different types of silviculture. So kind of stepping back and thinking about, well, transacting a project or developing a project to do improve forest management, if you are actually doing additionality through forest management, how do you sell carbon? Well, there's really two options in the carbon market. There's the compliance market, which is largely the California cap and trade market, and then there's a voluntary market, which is typically sort of one-off transactions, largely driven by corporate social responsibility interests. For example, Microsoft bought a carbon project in Washington State recently for about $14 a ton. In California, it's a more steady market. There's multiple buyers. The current price of carbon is somewhere between, I believe, $10 and $12 per ton, and is projected to increase given the structure of the market and the availability of pollution allowances. There's also sort of different structures and requirements of landowners participating in selling carbon in these markets. In the compliance market, it's a 25-year accrediting period, and for each credit issuance, there's a 100 years of monitoring required associated with that credit issuance. So a project length could actually be up to 125 years on any given land. In the voluntary market, there's a couple different registries and requirements, but typically it's a shorter time frame, less restrictive requirements. But that comes with a lower carbon price and less steady buyers in a thinner market. And then also the last sort of point of comparison is the way that baselines are actually calculated. So in California, with their protocol through the Air Resources Board, it's actually sort of this common practice baseline approach where they identify common carbon stocking across all private lands in a given region. In the voluntary market, it's more of a net present value sort of financial modeling approach to try to do that baseline comparison. So looking at the total volume that's been trading, this is the latest report out of Ecosystem Marketplace. You see in 2015, in that dark purple, this is purely forest carbon credits transacted. And in California, which is that dark purple, we saw about $63 million spent on domestic forest carbon credits in 2015. Basically, all that was going to fairly large projects over 10,000 acres each, and largely with institutional or industrial forest owners owning significantly large acres of parcels of land, and or conservation organizations also owning significantly large parcels of land. So basically, no family forest owners participating in that market. However, just looking at carbon stocks, it would appear that there is an opportunity. So in Oregon, what this bar chart is depicting is across all non-industrial forest land, you see gross carbon loss and carbon gain per year over this time period. And it's a net increase in terms of carbon stocking. So there is additionality just already occurring in these forests as compared to the industrial lands. The industrial forest lands, the similar bar chart would basically be a 1-to-1 ratio between gross carbon loss and gross carbon gain. But despite these lands, the family forests, not just in Oregon, but across the country, holding significant carbon stocks and experiencing carbon additionality as a result of their management, almost no family forest owners have benefited from carbon markets to date. So in my next section, I will talk about some work that we are doing to basically undertake trying to change that.
Thank you, Brian. For those of you just joining us, Brian Kittler from the Pinchot Institute's Western Regional Office has just presented about the background of his work, which actually initially revolved around generating new financial streams for forest owners in the context of rising healthcare costs, and how this is now linked to opportunities for tapping into the carbon market in the US for both improved forest management through additionality, as well as economic opportunities for family forest owners. So yeah, as Brian just said, he'll cover more details about a very interesting pilot projects, opportunities, and next steps. Thank you, Brian.
Thanks, Olivia. And a lot of what we do as an organization at the Pinchot Institute is try to find new opportunities in conservation and really experiment on the ground with those opportunities and work out the kinks. And carbon markets and family forest owners is a perfect example of that, because there certainly have been a lot of kinks along the way that I'll kind of hopefully explain, and we can have a discussion about. All right. So objectives of our pilot were to test, evaluate, and refine approaches to enable participation of family forest land in carbon markets, to create a working example of how market barriers can be overcome, and to distill lessons for both policy and for practitioners so that others can try to advance this conservation opportunity with forest owners. This work was a conservation innovation grant funded by USDA, Natural Resources Conservation Service, with match funding from the Meyer Memorial Trust and the Kelly Family Foundation. So our methodology was basically to look at a couple different proposed project structures. And we looked at an aggregation project in the voluntary market, and we looked at both the American Carbon Registry's Improved Forest Management Protocol and VCS's Improved Forest Management Protocol. The whole concept of aggregation is finding ways to basically treat multiple landowners as one project, one carbon credit project. And in this instance, we looked at designing a carbon inventory and stratifying across multiple owners, and all the sort of risks and opportunities associated with that. The second approach was a batch verification approach using the Air Resources Board Improved Forest Management Protocol in California that wouldn't treat multiple landowners as one project. Rather, it would be multiple landowners having their own carbon credit project, each with their own contracts. However, we would look to sort of develop these projects in parallel using a common system and have the verification of the inventory and all the paperwork associated with developing a carbon credit occur at the same time to try to achieve some efficiencies. The second aspect of looking at those two options was to complete preliminary carbon credit assessments with a group of landowners in a two-county area in Northwest Oregon. We sort of randomly chose this area. We knew that it was high carbon stocking. There was a large group of family forest owners, and we wanted to try to find a landscape where we could best investigate development of carbon credits with family forest owners. This seemed to fit the bill. The third piece was developing pro forma based on our initial assessments. So we had a good sense for, where landowners were based on these initial assessments relative to the regional carbon baseline, and we were able to, calculate in general terms their voluntary carbon market baseline. So we had a sense for potential carbon credit volume that could be generated on these properties, and we were in consultation with these landowners throughout that process. And we then looked at what it would actually cost, the costs involved with moving an aggregation project forward. And we also looked at the batch verification approach. And we're in consultation with landowners throughout that process. We moved from 30 landowners that we did the initial assessments with down to a group of 7 landowners that were both very interested in actually pursuing a carbon project and seemed to have the best potential, not only because of the level of interest, but because they had relatively high carbon stocks. We used funds from the Environmental Quality Incentives Program. This is a farm build program pretty widely utilized by family forest owners across the country. And we actually use those funds to subsidize the largest upfront transaction expense, which is the cost of carbon inventory. In our pilot, this was done through the CIG funds. We have sort of expanded since our pilots completed to be using EQIP funds across the Northwest through a regional conservation partnership program project that I'll talk about. The second aspect of the inventory where we tried to reduce some costs was really looking at an innovation with both the sampling design and the data collection using innovative technology. The last phase of our pilot was to move the credit projects towards development if the inventory was positive and if the landowners were receptive to the restrictions involved in the carbon market in the terms of a carbon contract. In terms of the inventory, again, we definitely are pushing the envelope here in terms of innovation and also the risk involved with doing a sort of a new approach. We're working with a firm out of Berkeley, California, Ecological Carbon Offset Partners, that's developed this sampling design. It's quite a bit different than a typical sampling design, which in theory will help reduce transaction costs going forward. We definitely sampled and inventoried a lot more plots on some of these properties than we likely would need to. But as this has never been done before, we definitely wanted to cover our bases and use a system that we had confidence in, and that we felt like as it moved to verification, we'd be able to see it verify. The other approach or interesting aspect of this is all the data is collected using smartphones with laser rangefinders and image capture, and that information is then analyzed and recorded, and it provides, in theory, a pretty seamless transition into the verification period. So the big test for the inventory is to actually have it verified, and that's kind of the next step in our pilot, or sort of the concluding step in the work that we've initiated. As far as the results, with this methodology, the inventory costs came in at about $14.25 per acre, which is slightly better than what we expected if we had used a standard inventory method. We do think that we could reduce the cost further by decreasing the sampling density and possibly using cheaper labor. In the pilot, we used a forester, and we really wanted to have this done, correctly the first time. But after, testing out the technology, we think there's actually an opportunity if it pans out. So um, stepping back to the pro forma, when we looked at the aggregation approach using the ACR IFM methodology and the, which was approved by ACR, we figured out pretty early on that stratifying across properties and developing a single carbon credit project, and then having a project developer or project proponent distributing revenues from that carbon program to individual landowners, there's a lot of risks involved, and there's also a lot of perception issues involved. Family forest owners, as I'm sure all of you know, are fairly individual, individualistic folks, and getting involved in a cooperative or something like that, they had some reservations about. Also, to get I think the more important factor here is that to actually, with this group of landowners, to have the deal penciled out, our sort of break-even carbon price was about $20 per ton, which really isn't happening right now in the voluntary carbon market. I mentioned one project that the Nisqually Land Trust transacted last year with Microsoft as the voluntary buyer. They actually used the Air Resources Board protocol, and they were only able to get about $14 per ton, I believe. We did look at the Air Resources Board in this batch verification approach. It does show some promise, but it also has some challenges. So landowners, some of which in our pilot pool were more interested in carbon, it turns out they were more interested in some of, a less restrictive approach, such as the voluntary approach. For some of them, the longer commitment of a ARB project gave them pause. One issue that was a sort of a significant one that came up was out-year transaction costs. So the monitoring expenses out 100 years, what is that actually going to cost? And to be honest, we don't really have a clear picture for what that expense is. Remote sensing holds promise, but it's kind of difficult to be developing a project today when you have no idea what those costs are going to be 10, 20, 40, 50, 100 years from now. In terms of the actual credit yield with the ARB IFM approach, with these 7 landowners across about 2,000 acres, again, this is highly productive, well-stocked forest land. We're producing about 655,000 metric tons of carbon dioxide equivalent carbon credits stored across these properties in the first 20 years. So definitely transactable volume. Going forward, based on conversations with the landowners and the results of the inventory and the cost projections for them, as well as the revenue projections, 3 of the 7 landowners have elected to move forward and pursue a compliance market opportunity. And that's basically how our pilot has concluded. Trying to scale this down to an individual landowner to give a little bit more context here. This 370-acre property turned out when we did the inventory is storing about 279 tons per acre, or 10 to 12 tons sequestered annually. It's a high site, very productive forest. And it's also an ecologically important forest. You have a stream running through here with migratory fish. And if you just look at the adjacent property, there's definitely some harvest pressure, and the history on this property had been that it had gone through a couple of rotations already. This landowner is interested in particular because their goals are to keep this land in their family. It's been in the family for 130 years, and they want to keep it that way for the next 130. So long-term proposition is actually pretty appealing for them. They're also interested in just being able to pay for some of the carrying costs of the property. And it turns out that carbon in the current market structure could present an opportunity for them to do that. So here is their projected carbon accretion over 100 years based on the current standing volume. And this is a grow-only scenario. So if they elected to basically stop doing any type of harvesting, this is how carbon would continue to accrue. And this is based on modeling with the forest vegetation simulator. So just include that caveat. So you can see that starting in year one, they're significantly above the regional average baseline. For this property, total over the 20 years, given current market pricing for carbon credits and projected pricing, it would be possible potentially for them to be generating about $1.3 million in carbon credits on that property over 20 years. This includes verification expenses. What this does not include is the cost of monitoring going forward after year 25 and the cost of re-inventory. So we paid the cost, recall with the initial inventory was Environmental Quality Incentives Program funding. We would like that to be an opportunity for the landowner going forward, but there's no sense that could actually, there's no assurance that could actually happen. Eco Partners, the firm that we're working with, who's developed the inventory technology, has suggested that is a system that would be fairly easy to do a re-inventory with, but that still involves some time. And if a landowner is not comfortable doing it themselves, which we think many of them won't be, there would be a cost there to them. Okay, so getting to lessons learned. Common deal breakers in the family forest owner demographic based on our pilot experience. So the transaction costs still are an issue. The opportunity cost is as well. Many of these landowners, especially larger acreages, are fairly financially motivated and accustomed to timber management. So timber is worth a lot more than carbon in dollar to dollar sense. So there's definitely an opportunity cost there. Market structure. My takeaway is that the compliance market really was not designed with family forest owners in mind, especially smaller acreages in mind. So there's some challenges there. This sort of hazy projections for out-year expenses is another place that gives landowners pause. And some of the limitations included in the ARB structure in their protocol, landowners do not have an appetite to take those on. We also saw some internal family disagreements about willingness to participate. Still, carbon is a great fit for some of the landowners, particularly the one that I mentioned, and others that are really geared towards ecological forestry and long-term conservation. We did experience that, interestingly, we walked into this assuming that more landowners would be really excited about a shorter term contract length, something in the 20 to 40 year time frame. Most of them, because they are older, however, basically said, it doesn't matter to me if I sign a 20-year contract or a 100-year contract or get involved in a 100-year deal. It matters less to me because I'm not going to be around. It's more what I'm going to be leaving the next generation and how this could potentially impact my ability to resell my property. Voluntary projects are difficult. The markets are thin and the price points really aren't what they need to be to have deals pencil out. And even with that, at this scale we're experiencing, that's really challenging in the compliance market as well. We do think that the use of cost share and evolving cost share programs, farm bill programs such as EQIP and the Conservation Stewardship Program could really help pay for some of those transaction expenses. And would also help USDA take credit for some of the investments that they're making in carbon conservation and help them track what those investments are actually resulting in terms of carbon uplift. We do believe that continued innovation in carbon inventory design, data collection, inventory analysis, modeling, and monitoring in these carbon projects, there's still a lot of opportunity for innovation there and cost reduction. We also haven't yet fully closed the door on aggregation. We do believe that in some instances, cooperatives could serve as aggregations. We're actually looking at a couple of projects which would be technically an aggregation project. It's significantly larger acreages and not nearly as many landowners as we looked at with this pilot. So we do think that there's still an opportunity there, but just not necessarily the way we originally scoped it with 7 to 10 landowners participating. And I think last, sort of certainly but not least, the concept of optimizing revenue associated with forest management from a combination of carbon credits and timber income. We think that there needs to be greater services provided to landowners in general with forest management planning that includes carbon management and forecasts of revenue. That's been a common observation of ours working with landowners. Their plans don't really do that. So one thing to look at here is in the first 25 years of a long-term ARB project, you're accumulating the carbon volume that you're responsible for maintaining. And actually, it's really in that first year, that initial carbon that you need to maintain. But in the out years in that monitoring period, there is potential harvestable carbon as timber as well. And that then becomes an important part of your financial picture as a forest owner. So that's a service that and an opportunity that we really see needing to be provided as these carbon markets develop, especially with marginal projects. Most of the really large carbon projects, those landowners have the capacity to do this type of modeling. Family forest owners typically don't, and they're not really seeing that service from most of the consulting foresters and public agency foresters that they're currently working with. As far as opportunities and next steps, we'll continue to be involved as the 3 landowners move toward carbon verification and hopefully carbon sale. We are pursuing right now a side-by-side inventory with using the smartphone approach versus the more traditional methodology. So we'll have detailed more of a detailed understanding, can develop understanding of the opportunities there. And we are pursuing this regional conservation partnership program project across a 14 county area involving carbon management planning, landowner technical assistance, education of technical assistance providers throughout the region about carbon markets and carbon management, and also using EQIP funding to fund carbon inventories. Again, this carbon and timber optimization analysis is really an opportunity and a need that we see with this landowner demographic. And the last element here of work that we're hoping to get more involved with as an organization is climate policy in both Oregon and Washington right now, and looking at opportunities to service this landowner demographic. Can we look at some elements of aggregation? Can we also look at opportunities to reduce the monitoring expense, possibly giving landowners an option for either doing 100 years of monitoring or possibly putting a carbon easement on their property to basically meet the same intent of keeping that carbon on the property for compliance purposes. Okay, I'll stop there. Covered a lot of ground, so I'm really looking forward to some questions and a bit of a discussion.
Thank you so much, Brian, for such a wonderful presentation. We have a couple minutes for Q&A from our audience, so we will jump right in. So a question about the context where all of this is happening. What might the recently announced 20% tariff on Canadian softwood lumber mean for carbon markets in the US, specifically for family forest owners starting to engage in these markets?
Yeah, it seems, I guess it's a good question. I guess the first point of inquiry or analysis would be that this tariff announcement isn't necessarily a new thing. We've had this trade dispute and duties on imports for a long time. The value of timber has increased as the housing market returns. This will likely push that further, and it will make carbon at current market pricing more of a challenge. So yeah, I think coming back to that optimization analysis and finding outreach methodologies to reach landowners that are really geared and interested to ecological forestry and long-term carbon conservation is going to be increasingly important.
Great, thank you. Now a question about the process itself for example, getting verified and just engaging in the carbon market. If family forest owners are pulled together for this process, would they need one additional entity, like one land manager or an additional verifier, to ensure everyone is managing equally as effectively, or what kind of standardization processes are in place?
Yeah, so essentially in the aggregation approach, each landowner, you would still be developing a carbon management plan and harvest forecast and carbon credit schedule for each property. The only efficiency that you're really gaining is that you're gathering the data for the inventory across multiple properties, and you're resampling and then developing based on individual properties. So each property would still need to participate in the verification process. There would likely be similar to, like, say, group certification, where an auditor comes out and will elect to audit a certain representative sample of properties. In the ARB approach, these are each individual projects, so they each have their own project design document. They each go through a separate verification. So those costs can double, but again, I would say double, but those costs they carry over to each property involved versus the aggregation approach. That said, based on the modeling and the projected carbon pricing involved and some of the other factors that we looked at, we had to get at about $20 per ton in the voluntary market to make it pencil out using the assumptions that we had.
Okay, great. So it does sound, from what you said, like you have found the voluntary market to be very thin. So we wanted to explore this a little bit more. Do you think there's potential for carbon offsets coming from family-owned forests to command higher prices in the voluntary markets in the future because there are more so-called charismatic? So meaning, would a buyer like Microsoft or like a big corporation pay more for offsets from a family-owned forest because that lets them have greater positive social impact?
I mean, that's been our working assumption with all of this. And I've had several conversations with companies, and they seem to be receptive to that idea. You explain the fact that most of the forest land that you see that's ringing our communities is family forest land. You go through all the statistics on forest land loss and the appeal of sort of the motherhood and apple pie aspect of family working lands, and the social context, and they do seem to get it. But it's a big effort to try to get an ecosystem services project voluntarily transacted. And there's risks. There are some risks to the buyers too, especially if it's sort of a new approach. But I do think that there's potential, if well marketed, for commanding a higher price. And that was actually some of the idea that we had initially, looking at linking back to the healthcare issue. If there's a potential carbon buyer that really understands and sympathize and empathize with these family forest owners who are facing challenges with medical expenses, and maybe they are even in the medical sector, medical industry, possibly they'd be willing to pay more to help get a deal done.
Okay, great, very interesting. So our last question is, is coming from another audience member who's wondering, to what extent are the families moving forward with carbon projects incorporating the long-term requirements of the program into the real estate planning?
Yeah, this is interesting. So estate planning is a big need that we've identified. We have another project that a colleague's been working on, looking at working lands across the country, and base level technical assistance and sort of conservation oriented management from professional foresters and consulting firms, we believe really needs to expand further to include estate planning, especially given where we're at with the demographics. Inherently, all the families that we talked with about their inventories and about their pro forma with carbon, this was a part of the conversation. I remember sitting at the kitchen table with the 7 members of the board of the family for that property that I kind of showed the carbon forecast for in this presentation. And we're talking about their forecasted carbon credits. And in the next room, there's, a 4-year-old girl playing, and it came down to, well, this is going to be 20 years from now when this project is moving into its next, its monitoring phase. The project developer is going to be talking to that girl, and she's going to be the one who will be involved in this. So yes, estate planning, this ownership transfer, these issues. I mean, it's huge. It's a big challenge, and definitely a financial need and service that really needs to be provided for these folks.
So we have unfortunately run out of time, but we'd like to thank you so much for a rich discussion today. The recording of the webinar will be available on our YouTube and iTunes channel, so please check back for that. And last but not least, be sure to check out the CBAY website and newsletter for more information about upcoming webinars and other events. My co-host, Corey Skult, and I would like to thank all of you for joining us today for this webinar. Have a great day.